Once when I was a young lawyer, I got talked into going to this brown bag series, and I really don't remember why I went. I mean, it was brown bag series. They weren't even serving food. Maybe the guy that took me had a new car that I wanted to see because the topic was allocation of purchase price. Even in You're a Lawyer, that doesn't sound cool. And it turned out to be the most valuable 45 minutes I've ever had. I go to this thing and it's the IRS head of audits for the region who's literally written a book, and he's talking about allocation of purchase price, which is when you buy a business, you're going to fill out Form 8594, which you designate a value to different classes of assets. And there's a tension that exists between the buyer and the seller with how they're going to designate that value so that they get, on the sell side, minimize the tax consequences of the sale. On the buy side, maximize the amount of deductible assets over the shortest period of time. These things are in contrast to each other. So the lower the buyer value on the attractive assets for tax reasons, from the seller's perspective, the higher the sellers. When buyers and sellers are allocating purchase price, there is a tension that exists in some of the categories where in some categories, if it's higher, that's better for the seller because they have less tax consequences. And if it's higher in certain consequences, it's better for the buyer. They have a more tax advantageous future. They have more to deduct. This can be a bigger or smaller deal depending on what you're buying. And I'm not going to get into what goes where and all of that because your accountants can completely nerd out on that. But what happens is there's this idea that the buyer and seller have to agree. I've seen some super stupid fights over trying to agree on allocation of purchase price. What I learned from the guy from the IRS is you don't have to agree. And he pointed out something that I've now pointed out 100 times, and every time I do it, whichever professional I'm dealing with, even though they might be an accountant or an attorney who deals in acquisitions, there's a little box. Did buyer and seller agree on the allocation? Yes or no? Well, why in the hell would the IRS put no if you had to agree? The point of the whole thing was, what are the consequences of not agreeing? And it's like this. Most professionals who do this think that if you don't agree, you're going to get audited. You're not. That is not an audit flag. If you don't agree, you are not necessarily going to get audited. And if one side gets audited, it does not mean the other side automatically gets audited. The advantage of agreeing is that if either one of you gets audited, you have the burden shift to the Internal Revenue Service to prove that your allocation is wrong. Whereas if you don't agree, it's your burden, the taxpayer's burden, to prove that your allocation is wrong. The point the guy made was, you could have different allocations, you could both get audited, and you could both successfully defend your own allocation. And just because one person gets audited and has it wrong isn't automatic that the other one's going to get audited. What bothers me about the context and the way this plays out professionally is that the professionals I see doing it are managing the issue with fear and not giving clients a true look at the consequences, at the choices, at the decisions. And so I've saved all kinds of time by just explaining to my client how it works if we don't agree, and then just talking to the other side and said, look, this is getting ridiculous. We're just not going to agree. You just do your own allocation. We'll do ours. We think ours is defensible. You do whatever you want to do. And invariably, our accountant says we have to agree. You don't. Our accountant says we're going to get audited. You're not. Well, you might, but you're not any more likely to get audited. And this isn't a flag. When your attorneys and accountants are taking you off on an argument over this issue that doesn't actually exist, costing you thousands of dollars and endangering your transaction, hopefully you've watched this video and benefited from the most consequential 45 minutes in continuing education I ever had since I started doing this longer ago than I would care to admit. And that's all I have to say about that. When you're allocating purchase price, there's 7 different classes and a lot of stuff gets lumped. And so intangibles and things like non-competes, things that are not solid, go into a category that requires you to depreciate them over 10 years. Hard assets, like chairs and tables and stuff that you pick up and move around, that goes into a 5-year depreciation. This is where the tension is. The more goodwill that goes into the allocation, the better it is for the seller, because they're not going to have taxes recaptured on assets that they've depreciated because it's just going into goodwill. It's less good if it's in goodwill because they're going to have a lower basis in those hard assets to depreciate over 5 years. Is this the end of the world? No. And sometimes the distinction over how much goes in what is a bit of a tempest in a teapot, like depending on the size of the transaction. How much difference could there be possibly tax-wise between depreciating things over 5 years versus 10? There's some other interplay between those things that gets overblown, which is if you're depreciating to the category of hard assets and you're in a state that has sales tax on those things, do those have to be the same? No, they don't. Whatever you submit for sales tax doesn't have to be whatever goes in that category, and they're not always exactly the same. Why does the allocation matter? It's just really a struggle, I guess. As buyer, will you have more or less things to deduct in any given year? If you put it into goodwill, it gets spread out over 10 years, and so of course, less deduction each year. And if you put it into a more aggressively depreciable asset, and you can depreciate it over 5 years, then you have more deduction over 5 years because you've pushed it into a 5-year category. On the sell side, if you push it all into the hard asset category, they're gonna have to look at their basis in that asset. And if it's more, they're gonna have to pay capital gain on that. Or if the asset has been fully depreciated, they might have some recapture of their deductions because they depreciated the asset but didn't get to the end of its useful life. And so they will have phantom gain, phantom income tax on the depreciation recapture. It can matter a lot. That's the point as far as that goes. My point here is I've seen it jeopardize transactions and I've seen it cost money trying to come to some kind of conclusion. And the truth is both sides can manage their taxes separately if they just have the courage and the knowledge, the ability, they know that they can do this separately, and the courage to learn, understand, and deal with the potential consequences, which are limited in my opinion. As a professional, then you've given your clients the full picture, and as a client, you've gotten it. Your professional has done their job in that they have given you all of the choices that you actually have, rather than just stand there and scare you by saying, oh, you have to agree, and we're gonna have to fight about this. And if we can't agree, maybe this acquisition goes away. You don't have to agree. And in terms of handling this issue and all your transactional acquisition issues, we do that. So call us.